Let's find out how the year ahead is likely to be and how is it that you should be investing in this current market scenario. And who better than Sandeep Tandon joining in to throw us or give us insight on exactly that. Sandeep, hi, good morning. Great to have you on the show and
Yeah,
wish
very
you
good
and your
morning.
entire team at Quant a very happy new year, firstly, from all of us.
Yeah, same to you and your viewers also.
Thank you, Sandeep. Sandeep, I was just thinking about your style of investing, and you've always emphasized on data over emotion. Given the kind of data points we've had thrown at us all through 2025, what's that one data point that really stood out for you? And how is it that you overcame that and, put it into your investment strategies?
The important or a key data point is that when you see this sort of extreme level of greed comes in, in some of the stocks with the valuation spiking, how well you are able to hold your emotions and not able to say no to these opportunities. Also, I think that will be an important observation because a lot of people get sucked in these cycles. And maybe in historical, we have seen, when you actually sucked in at the peak of the cycle, and then the impact is much more meaningful, more psychological, less financial, and that has its own impact on your own uh, over understanding of the market or the portfolio construction.
Interesting. So, Sandeep, how would you summarize the year gone by and what's been the learning? Because unfortunately, barring a few odd pockets here and there or individual stocks, that greed was completely amiss. I mean, even when the Nifty clocked that all time high, look at what was happening to individual portfolios thanks to mid and small cap performance.
See, the important learning is that even if you really look at even best of the money managers, smart strategists, best of the investors, who people respect, they also get carried away when we are seeing that promoters are selling, private equities are selling, fully knowing that I always believe one thesis, if promoters are the biggest insider, okay, private equity are quasi promoter, they are the biggest insider. When they sell, they don't see value at these particular prices. Then how come we as a money manager see value in some of these names? Okay, so that is the important observation, and we see best of the names getting carried away in these participation. And we all talk about the supply is very large, but look at the money flow which is mutual funds are getting. Everybody say there are other opportunities also. Is not necessary you to participate, fully knowing that promoters are exiting, fully knowing the valuations are expensive, and we all tend to participate. Obviously, it's one can blame to the bankers and the brokers or the promoter. Is the investor themselves to be blamed first, because they are participating. We always hear that, okay, IPOs are coming at expensive valuation, regulators should look into it, or the banker should look into it. Why not investors should themselves? They have to do their own analysis whether they want to participate. Since they are participating, if there's a demand, supply will come at every price. So it's all about demand game. If there is no demand, the supply will not come. So that's an important learning and observation which we saw in 2025. So it was like unforgettable 2025. I think something similar trend you might see in maybe in the beginning of 2026 also, because that cycle is still not peaked out. People are still participating.
Sure. But Sandeep, do you see a comeback for mid and small caps which didn't participate as much and people's personal portfolios did see quite a sharp crack because of their underperformance?
So not all. Okay, if you say that it will be all around bullish move, no. I'm looking at select opportunity, the sector which has or the stock we talk about, which are relatively attractive valuation now, relatively under owned. They are trading in neglected zone. Those are the stocks will has potentials to come back, and there's a trend we have seen. When the bounces come, these are the name which is coming back as compared to all those names which were in fully admired territory, expensive valuation, extraordinary hype. Those are the names I think suffering has just started. The big pain is still pending.
Hi Sandeep, morning. This is Harsh here. Sandeep, therefore, what are those sectors that you feel will come or come make a bit of a comeback in 2026 as part of the rotation? A couple of sectors which have suffered is IT, real estate. Are those the sectors to actually focus on?
So let's understand from India macro perspective as compared to January 2025 versus January 2026. Okay. Uh, our macro picture is far more superior. Okay. We have seen extreme exhaustion in the selling point, which we have seen from the FIS perspective. So if I look at the cumulative data points in 2025 was the beginning of that correction. And I think it's a bottoming characteristic, which we are seeing. It was a peaking characteristic in 2025 and 2026, a bottoming characteristic. So when economy is coming back, government is putting a lot of effort in boosting the consumption, whether from the GST rationalization or talk about income tax perspective or some policy changes. I think then 2026 should be a better year as compared to 2025. And obviously, the economy is going to come back. Now, anything which is more related to economics centric stocks should do better, whether you talk about NBFC, whether you talk about banks, you talk about large infra names. Despite that, capex cycle has reduced a bit, okay, and overall capex has come down. But I think there are certain opportunities which is visible because some of these names have corrected or consolidated for a longer period of time. And I think these are the name has potential to recover from the current levels.
Sandeep, you were just earlier alluding to that there are pockets in the market which maybe are consolidating right now, but the real pain is still to be felt. What sectors were you alluding to?
I think all these hype which we have seen in the so-called new age expensive IPO, this is the pain point, okay, where supply will come keep on coming on let's say perpetual basis because a private equity has to exit, they will exit, okay, till the time their holding comes down to zero. So this is the where I see major amount of pain because last year extraordinary money went to some of these names and a lot of people are stuck. Okay, if you now sit down and analyze the IPO, what is the number of IPO came, what is the and how many stocks are trading below the IPO price and how many stocks are trading significantly below the IPO price, you will get some answers. Okay, and as time passes, 1 quarter, 2 quarter, 1 year, people will startly getting impatient about it that they are getting negative returns and market things. So it's a mindset which will lead to some amount of capitulation which has still not happened, and I see maybe 2026 will be remembered for capitulation in some of these names. So that's the reason I'm saying the pain is still pending in some of these names where extraordinary hype got built and is still getting built. So it's not that cycle is peaked out. A lot of people are, and the best of the names are very, very complacent about in a name that I will deploy 10%, 20%, 30% in so-called expensive new age IPOs.
I get that point, Sandeep, about the new age IPOs. But I also want to talk about one of the most loved stocks within the QCOM space, Eternal, right? It's the eternal stock in everyone's portfolio. Even that is lagging because of, various many disruptions at play that also was getting a little bit, frothy. People did make a great amount of money. And now you've got a new entrant coming into that space, which has just recently filed for an IPO. What's playing out within QCOM?
So I will not able to comment on
Sure.
individual stocks. Okay, as you know, we don't own any of these names, and we have no intent to participate in the coming IPOs also. So the way only thing I will that's the way I was describing. These all names are part of a larger thesis. Let's say the real activity happen in US. Okay, and when people talk about whether it's a bubble in US, answer is no. Bubble is actually here because the number of stocks or the opportunities India was very limited, and hence with limited opportunity, extraordinary money flow was there. And that's the reason these stocks become much more expensive than the US or the China tech companies. And hence that's my concern. So I will like to just avoid some of these names. See, last year when economy was doing bad and these so-called these names were doing extraordinary in terms of top line growth, at least there was a growth visibility, money got shifted. And I think now reverse trend has just begun and it can gather momentum in 2026.
Sandeep, therefore, are you, because you're being cautious, are you sitting more on cash? Is that the way in which you're shaping up in terms of your holdings?
No, we are not sitting on very large cash. We have
Okay.
deployed in the sectors, which we like some of these names which I talked about. So we are more interested in the old age companies, the traditional companies, which has been beaten down, underperformed the market, valuations are attractive, and they are in the, if a not hated zone, they are not definitely in the admired territory. People don't like some of these names. People don't want to even discuss these names. So those are the names I think will do better in 2026 and gives me, they are more liquid, they are more safe. So I think that 2026 for me as a house, we always saying the liquidity is the first priority, safety is second, and return comes third. Okay. So, and if you can achieve this, then by default your portfolio will do better than the market, because that's the trend which I'm seeing. The impact cost in the market has been nearly 1.5 years now remains elevated. Volumes are shrinking. These are the pain points, in some of the areas. If you look at, so if you want to exit, there's a huge cost. You want to build your exposure, that also is a cost. So obviously, when you see rising impact cost, typically rising impact cost has implies a lot of pain point from the market.
Sandeep, how do you look at some of the defense stocks, especially defense PSU stocks?
So defense as a space is definitely very good. We like, because that's given the geopolitical noise, or we have been talking about the rising geopolitical environment, which can last for another 5, 7 years. So obviously, from a strategic point of view, obviously it's a perfect sector. You should be participating, but the challenge of the sector is that nothing is very cheap. Price has extraordinary growth has already been built in some of these prices. So I think the way I will look at, if there's an extraordinary fall and correction which do happens from time to time, if you get some of these opportunity, that I think this sector is buy on dips, but currently they are expensive.
Okay. Sandeep, how do you look at metals, therefore? We've seen, again, a very strong rally. Cautious with regard to metals?
No, we are constructive on metal. The only
Sure.
challenge is that when you are in a very difficult global environment, we're talking about trade war, global uncertainty related to the currencies, you have issues with China. A lot of things are there which does not give you comfort to build up a very sizable position. You can trade in some of these names, or you can have a smaller exposure, but background is not that constructive to say I go all out and build my exposure. Despite that, the sector has done extremely well in last few months or maybe few quarters. So I think from these levels, I'm not negative, but I'll be cautious in building exposure from the current levels.
The start of the year, I recall, or actually when the entire India US trade scuttle began, you were very convinced about pharmaceuticals. From being a CDMO story, it's now completely turned into a GLP-1 story now. Where do you think the trend for pharma is headed next, and where would you scout for winners within pharma?
See, let's understand pharma. I always say we are in a similar situation which IT was there in 20 years back. Okay. So if India is in the driving seat as far pharma sector is concerned, and particularly generic, there is no competition for us globally. And given the number of US FDA plants which we have, and the comfort which we have in both in terms of quality as well as the management, I think these are the data points which gives us edge over China big time. And hence, we think there is no substitute for Indian pharmaceutical companies, and hence they will remain a long run bull thesis. And I think I'm not talking just 1, 2 year perspective. I think it's a decadal opportunity where India can actually demonstrate. And if you really look at, we have very sizable market share in generic, and we are expanding in whether it's talk about CDMO or not talking about biologics or any new area which is picking up. This is a one area which, as a house, we have been very constructive, though they have not done much also in 2025. But still, we remain constructive, and given the weakness in the dollar, which we have seen, that automatically gives you a great hedge. So I think all the construct is constructive for this space. So I like to remain overweight in this sector. The downside is limited and upside could be meaningful.
Okay. Sandeep, financials. It's obviously the largest construct within the Nifty 50 index. What within financials do you believe will do well? You've spoken about your tilt towards PSUs, but talk to us about some of the other pockets relative to the PSU pack.
I think from a relative perspective, I think in within financials, I think like NBFC has done well. I think it still has potential to rally further. Another area which has been highlighting for a while is about the insurance sector. Insurance is one area which has been now traded in the neglected zone sort of thing, and they're liquid names, large cap names, okay, and all the headwinds related to the industry which we are facing for last maybe few quarters are settling down. So I think that's the one area where again your downside is limited and upside is open. So insurance fits a bill, life insurance company particularly fits that bill. So we are very constructive and we have increased our exposure in this sector in the last 2 months or so.
Ask you to pick up that one sector for 2026 wherein you are willing to take or recommend sizable bets where you think there will be that profit pool creation and alpha generation as well. Which would that one sector be?
So as I said in the beginning, also you asked me, I think it's a no-brainer trade is still a pharma. Okay, pharma gives you huge comfort because my downside is protected. Global background is constructive, and every data point is more constructive. See, we look at skewness in our data when we are seeing more positive, and you will see quarter on quarter improvement in these generic companies. Also, there's a one area which I think where my downside is limited and upside could be very meaningful. This is a very simple trade we should participate, remain overweight in pharmaceuticals.
Okay, the Pharma bull on pharmas. Sandeep Tandon, thank you so much for your time.
Thank you.
Pleasure.